When you get started in business, you probably think all you need to worry about is the product or service that you've got to deliver. Just get that right, find the customers, and job's done. However, there's obviously a lot of legal and finance things that you need to worry about too when you start up a limited company. And the one we're going to talk about today is how many shares your startup should have. Now, the obvious answer, which when you talk to any professional about that, will be it depends, which isn't really particularly helpful. So in this video, we're going to talk about what are the factors involved when it comes to making that decision of how many shares you have in your startup, the types of shares that you're going to need to think about potentially, and also why flexibility is the key thing that you need to think about long term in terms of when you make the short term decision of how many shares your startup's going to have. Before we get into detail, please don't forget to subscribe, where we've got lots more videos on the basics of business with hints and tips on how you get your startup formed and established. But what we're going to do in this video is going to take you through a few things about what are shares, and then we're going to get into some practical examples to help. So Neil, probably first thing we do when we're coming to that question is what are shares? It's probably the first thing that we need to tell everyone what they are before we get into how many you should have.
Yeah, and I think the simplest way to describe that is shares are like the currency or the piece of paper that a company issues in return for investment, in return for cash. So if you're going to invest in a company, you give the company money and it gives you a number of shares in return, and that indicates how much of the company you own, control and have influence over.
But a key point is it doesn't have to be money.
No, it doesn't have to be money. No, you could work for, sweat equity is the term that people use, where you get shares in return for providing some form of service or something else for the company. It doesn't have to be cash.
Okay. So, there are a number of factors involved, and as I say, it does depend. We're sort of being a bit tongue-in-cheek. It does depend. However, we're trying to give you some practical examples here of the factors that are relevant, and there are 6 we're going to take you through. There, as we see just there's keeping the maths easy is one of the things we want to do. Future-proofing in terms of thinking of investment. There's that thing we talked about there of money versus sweat equity, where you're paying in time rather than in money for your shares. There's an image question in terms of perception of the company. There's a thing called share premiums, which Neil, I'll let you talk about a bit more. And types of shares is obviously, there are various types of shares, and that's a key thing that we need to consider. So taking the first one, if we're looking at keeping the maths easy, why is that an important thing when it comes to how many shares you need in your startup?
Well, it's just, it's a good mantra for everything really. Keep it as simple as possible. Why overcomplicate things? People, very often people will do that, and there's no need to. So at its simplest, as the slide there shows, if there's 3 of you starting a business together and you're going to own it a third each, then you just need 1 share each, and 3 shares would be enough to at least deal with the percentage of ownership and control that the 3 people forming the company or starting a business together would have, and that that is at its simplest the easy way to do it, and you could just do that. There will be, which we'll come on to, there's lots of other considerations that could be taken into account to decide how many shares, but it still needs to be a third each if you're going to have 3 people owning a third. So 1 each is as simple as it can get.
So you've advised a lot of businesses, and is there any times you've seen people not trying to make it maths easy in terms of they've just got themselves in a mess, in terms of rather than just sticking to that basic of, if there's 3 of us, 3 shares, if there's 4 of us, 4 shares, and whatever proportion we're talking about, like we've looked at there in the slide of 60%, get the maths easy, 6 shares, if there's another 2 shares each, 20%, etc. Are there any reasons why you wouldn't keep the maths easy?
There can be all sorts of, for keeping the maths easy, no, I think that's a key requirement, and later on in the life of the company that can come back and haunt people if they haven't thought about the maths, and the second point that we had was the sort of future proofing. So, but that is still linked to keeping the maths easy. So, for example, if you've issued a company and it's you and I, we've got 50 shares each, is 100 shares, and then in a couple of years' time we want to take some investment, then there's only 100 shares in issue. The number of decimal points effectively as to how many shares, if someone's going to put money in for 3% of the company or 5% of the company or 10% of the company, the 100 shares, the subdivision of that is into different percentages is not as easy. Whereas for the same amount of money going in, we could have 500 shares each or 5,000 shares each or 50,000 shares each. The amount of money that goes in doesn't have to change, but the number of shares you get can be wildly different. And if we had 10,000 shares in issue, then we can give away or we can seek investment for much smaller percentages because it's still a round number of shares. And very often those are the sorts of things when we talk about future proofing is investment, or if you were trying to do anything with future employees, you're thinking of share option schemes and things like that. So again, the larger the number of shares, the easier it is to give people an option or take an investment over a certain percentage, because whereas the smaller the number of shares, it's almost like the bigger the percentage needs to be for the options and the investment.
And it's it. So we can keep the math simple when we start. I mean, if it's you and me and we've got 100 shares, we can just have 50-50. But in terms of by having that 100, if we take on some investment, as we're looking at the slide there, you can then just give up proportions of those 50 to the investors as they come along.
That's correct. Yeah. So that would be where I say the keeping it simple and the future proofing is having the different number of shares. And I think where we talked about share premiums later on, but that's where you can issue shares. Don't have to be for the same amount of money. So a share, when it exists, is the terminology is they call it's an ordinary share of the company, and it has a nominal value of £1 each, and that's sort of what starts. So if we were starting up in business, in theory, I've got to put £50 in to get 50 £1 shares. You put £50 in. So that's where, at its simplest, how it works. But what we could do is we could have 10,000 penny shares, and I'd still put £50 in, but I'd get 5,000 shares instead of only 50. So that way it can work through, and that's where we have to share premiums and things. But so the amount of money doesn't have to change, but the number of shares can. And that again is, we sort of jumping ahead in terms of the perception and things as well. Does it look as if you're a bigger, more successful company because you've got 10,000 shares in issue instead of 1 or 100 or whatever? And so there is an element that some people feel that sort of shows that they have future-proofed it, and there are plans for the company. It's not just me and you just going to be running this company on our own forever, and it's a lifestyle business. By having a number of shares that are there, that can mean people's perception of the company is different.
It's different. Okay, so we're going to come on to that a wee bit later on, but in terms of factor 2, just as we've got there, future proofing, we can keep the math simple both at the beginning and as we progress. And just the example we've given there, giving 100 shares, it's an easy thing to divide. If you're the main shoulder starting off on your own, you can give yourself all 100 to start with, and then when your 5 investors come on, the 100 makes the math easy in terms of give them 5 each and they've got up to 5%.
Yeah.
Moving on to the third factor, which we want to talk about, is just as Neil touched on a bit there, and we've talked about a bit previously, is it doesn't have to be money. I know it's an obvious thing to think about in terms of shares. You've got to pay for them, but you can use your work to pay for them as well.
Yeah, and there's some funny little tax issues that can come around that as well. So if, for example, you say to someone, right, I'm going to come and work in your company and going to charge you £10,000 for doing something, and you say, well, instead of paying you £10,000, I'll give you a percentage of the company or give you some shares. Technically, you are actually performing the service and being paid to do that service, so you should be declaring that £10,000 as if you've received it, and you'll pay tax on it, even though all you've had is some share certificates instead of cash to pay the tax. So sweat equity generally isn't referred to in those cases, because that is actually just a normal trading transaction, but instead of receiving cash, you've received shares. Sweat equity usually would be referred to where I will take a stake in a company and work to help grow or do whatever it is with that company and be involved with the company for the services, but it's not a sort of finite, here's a service I'm going to do, here's a period of time I'm going to work. I would normally charge X and in return I'll take shares. Sweat equity is more the skills you have, the things you can bring to the company will be useful over whilst we started up and beyond. And for that, you get a stake in the company without actually having to put any money in.
But it's also something for founders to be a bit wary of in terms of just an investor. If you've started something, you're doing well, and then someone comes along and says, oh, I'll give you a bit of help and give me 20%. So you've got to be careful who you...
It sounds cheap, because you're not actually, you're getting an experienced marketeer or accountant or whatever it is to come and help you with your business as you start up, and you can't afford to pay them what they would normally want for their hourly or day rate. So you can kid yourself that it's not expensive to give away shares, but actually forever you've then got that person with a stake in your business, and
who doesn't necessarily deliver what.
And there's all the anecdotes, isn't there, about the people who have done work for Google and Apple and things like that and been paid in shares, and and then suddenly it was a very expensive piece of work that they did.
So it's something to be wary of, as well as it being an option in terms of just give it. It's not, don't give away equity lightly. No. And in terms of, particularly when it comes to investors further down the line, I'd be wary of ones that are not going to put money on the table versus ones that are giving time. Not that it's not an option, but if you've generated something that's delivering a bit of success, it's certainly not something to give away lightly.
I think you need to always be very careful about who you want to own a part of your business. So whether they put money in or not, you're going to be in a relationship with them for a long time. And so if someone has come along and done something, and in return you give them some shares, they're involved forever. Or someone's got to buy them out. And that can have, knock-on effects when later, a year, 2 years down the line, you're trying to raise some money. There's now another investor, there's someone else whose opinion or whose involvement has to be dealt with. If you're trying to, sell or do other things, you've got these people involved.
And the buyout rarely comes in sweat.
No, exactly.
It's money.
Yeah.
Just on to factor 4, I know we've touched on it, the image of the company thing. Do you think that is genuinely a big thing in terms of numbers, or?
Personally, I don't, but I do know that people do look at those things, and that's why there are a lot of companies with £1,000 of share capital or £10,000 of share capital instead of just 100 or 1. But realistically, is the company so much more financially strong because it's got 10,000 shares in issue instead of 100 or 1,000 shares? It is just perception, but to some extent, people do that with PLCs. The word PLC as people think that is a more substantial company than a limited company, but it is just a name, and it's just as easy for you and I to set up a PLC and put a few pounds in as it is to set up a limited company. There's a little bit more to it than that, but realistically, a lot of people, when they set up PLCs, they're doing it for the marketing aspect, the perception aspect, not no intention of ever actually floating on a market, which is the main purpose for having a PLC.
The one caveat to it is you've got to remember the liability point as well, don't you? In terms of if you have a higher number of shares and share capital, there's a liability aspect.
There is, but obviously you are limited to what you paid for the shares.
Yeah.
So, your liability is still limited to what the value of the shares is, and provided you've paid for them. So if it is, 5,000 penny shares that cost £50, once I've put up my £50,
Yeah.
my liability
But
is
that's the
restricted
denomination
to that.
thing. So classically it would be 100 shares at £1.
Yeah.
If you want a bigger share, if you want a bigger number of shares, don't forget to maybe drop down the
denomination.
denomination.
Yes. Yeah, the nominal value.
So you're
definitely.
not, 1,000 shares. Oh, I want no more shares. There's £1,000 we've got to come up with rather than 100.
And you are able to, later on in the life of the company, you can subdivide shares. So if we started off with 100 £1 shares, there is a mechanism for us to change that to 10,000 penny shares.
Yeah.
You don't have to stick with it forever, but again, it's
You
paperwork, and that. So if you think you're going to do that, why not do it from the outset when it wouldn't cost you anything?
Yeah.
And that's that sort of the future-proofing bit and the presentation part.
And the concept of the share premiums element, in terms of when's that, have you seen that typically?
Very often with startups and early stage businesses. So, for example, if you and I are starting up in business and we're going to be doing all the work, but we've got someone with money who's going to fund it, and we're going to have it a third each. So let's just pick a number. We need £100,000 to get this business off the ground.
Yeah.
Someone's going to put in £100,000 for a third of the business. We haven't got £100,000 each, but we also are going to have a third of the business. So you can either try and do it with the timing of it, that we are going to pay for our shares at a different time, but at a lower rate. So if we're going to have 100 shares for £100, or 33 shares rather for £33, I put my £33 in, you put your £33 in.
Yeah.
Our money man comes along and he puts £100,000 in, but all he gets is 33 shares as well. Then that's where he's got a, whatever it is, 99,977 £67 share premium on top of the £33 for the share. So that's how you will see premiums very early on in a company, is where particularly the founders maybe don't have the funds, so they put in a nominal amount of money, and the money people come in and they get exactly the same number of shares, but they paid a significant premium over the nominal pound or penny.
And are there any
shares.
potential impacts of that later on down the line that people would need to be aware of?
No, not really. No, I mean it's still the part of the share capital of the business, so it strengthens the balance sheet. It's real money that's gone into the company, £100,000, and then various things later on. That the difference between it being share capital or share premium doesn't prevent you from doing anything in the future.
Yeah, and we've got another video around understanding limited company accounts. So in terms of that, it's probably a good example that we show there of how that can strengthen the balance sheet in terms of the share premium.
Exactly.
At that point.
Yeah.
And the final factor we wanted to talk about was the types of shares. Now I think everyone thinks of particularly limited company ordinary shares, but there are lots of other different types of shares. And I suppose the obvious first question is why? And as we talk about there, the sort of four of the top reasons are attracting investment, amending of voting rights, and we'll give that a bit more flesh in terms of when we go through the specific examples, but different voting rights can come with different types of shares. You can pay dividends in different types of ways with different types of shares. And it's also a mechanism a lot of companies use to try and give incentives for staff to stay, in terms of they attach shares as part of, please, the longer they stay, they'll get shares further on down the line from that, rather. So just it's an incentive together with their salary, obviously. If this is a good company to work for and you stick with us, we generate success, you'll share in that success.
Yeah, so
later on down the line.
As the slide there shows, the two sort of company law references to shares would be ordinary share capital, which is generally, that's, as it says, the ordinary shares, one person, one vote, one person, £1 pound of dividend that gets distributed with the profits. And that's, just everybody sharing equally in the success and whatever of the business. The other type of share is a preference share, which is, by its name, is there is some form of right, preferred right, attaching to that share rather than the ordinary shares. And that might be they have a higher percentage of votes. It might be they get more of the capital on a sale. It might be they get more of the dividends of the profits when they're distributed. They might have an actual fixed interest rate attaching to them, so they get a guaranteed amount of return. And those are the sorts of things that when you're looking for investors, giving them some sort of preference, making sure they get the first X pounds of profit is distributed to the preference shares, or allowing them twice as many votes or whatever. So those are where the preference shares come in. And then the other one, the alphabet shares, that's where usually they will be ordinary shares, but you then have ordinary A shares, ordinary B shares, ordinary C shares. That's why they have the name the alphabet shares. And people would use that because it's more of a tax planning mechanism where you and I could have the business 50-50, you own 50 ordinary A shares, I own 50 ordinary B shares. And what that would allow us to do then is to reward each other in different proportions to how we own the business. So although we might own the business 50-50, you're working in the business more than I am. So we can agree that you can have a bigger share of the profits than I have, because the A shares, we can vote it differently. You do need to be very careful with those. For obvious reasons, the taxman does not like alphabet shares, but very often that's how they're, again, structured from the beginning. You might not be thinking you're going to do that, but that future-proofing bit, again, is if there's three of you setting up in business together, why not do A, B and C shares? You all have the same voting, you all have the same dividends, unless later on you decide you don't. You've got that flexibility then to be allowed to create a different structure.
And that sort of brings everything quite nicely. It's that flexibility point in terms of, and there's a lot of information into, I think a lot of people and they will hit, a lot of companies will just set up 100 shares at £1, which is absolutely fine. It's just a case of just being aware of, you want to create that flexibility if you can from the beginning, because you can make changes later on, but it's going to take some time, and it's going to be some costs, and the longer you've been in business, probably the more complex it's going to be. So you want to get it. Why not get it right from the outset?
You do as well, because once the business is up and running and actually started, then playing around with shares at that point can trigger tax issues. It can trigger other company law issues. But if suddenly you said, oh, actually, I now want you to have some B shares because you're doing more than I am, and we want to give you some more thing. Well, the taxman will look at it and say, well, because you're giving him shares, they've got a value. You'll end up getting a tax liability because we've issued some new B shares further down the line. So again, it is worth spending some time thinking about what might we want to do in the future. What options are open to us, so that you can then create those shares and set it up from the off.
And you will, even after that thought process, you're probably going to you want to keep the maths easy, you want to keep it simple, but you want to have gone through these factors so that your end result is the right one for your business. And it's where we've got another video on, do you really need an accountant? And that's an important thing for us to talk about, as in, you kind of say, there's no problem at all with setting up a company. I don't know, you've got other friends who started one up, just do 100 shares at £1 or £1, absolutely fine. However, what an accountant may help you do is just go through the thought process of why that is the right thing for you, or whether there's potentially another
because they'll have seen it before.
Shares.
You're setting up in business for the first time. You won't have the experience that hopefully your accountant or lawyer does have, and say, well, actually, some people, 3 years down the line, they realised they wanted to do X, and it's more difficult because they didn't think about it at the beginning. So again, whether it's an accountant or a lawyer or someone in business, just asking around, getting a bit of advice about how should we set it up and structure it to, as I said, for that future proofing and that flexibility later on.
So hope that's been helpful. on the question of how many shares your startup should have. Please subscribe, and you'll get some other videos on this subject and others around how to get your business established and going. But I hope you've enjoyed this one, and we'll see you again.